Well, good morning. My name is Darren Peschel, and I'm a Senior Vice President here at the Federal Reserve Bank of Dallas. And on behalf of our nation's central bank, I want to extend a warm welcome to each of you. We're very pleased to be hosting the 2023 Business Outlook Breakfast, sponsored by the University of Texas McCombs School of Business. And let me just say what a pleasure it is to be back in person again. So we've been doing, yes. So I love the energy and the enthusiasm of the room, and thank you for showing up today. This is probably the most people we've ever had in this room. So we had to move the food outside just to accommodate everybody, and we still had a waiting list. So as a proud alum myself, it's a special pleasure to be collaborating with the McCombs School, as I know firsthand the outstanding work that Dean Mills and her staff do in Austin, as well as how much the school contributes to the economic success of our state. In fact, when Dallas Fed President Lori Logan was choosing where in the Federal Reserve District, and our district covers all of Texas, part of New Mexico and Louisiana, when she was choosing where in our district to give her inaugural speech a couple of months ago, she chose Rolling Hall at McCombs. And thank you again, Dean Mills, for that special privilege. Turning to this morning, let me say how fortunate we are to have today's esteemed panelists. In many ways, the program today reflects the approach we at the Fed take in our work, looking at economic sectors and balancing both local and national perspectives. And at the conclusion of today's program, I invite you to learn more about the Federal Reserve System in our Visitor Center, where you can learn about our role in banking supervision, monetary policy, and financial stability. And now it's my distinct pleasure to turn the program over to Dean Mills, so please join me in a warm welcome for Dean Mills.
Darren, thank you so much for welcoming me and all of us here today. It is our 11th annual event. I'm so glad to be back in person. This annual tradition is very important to me. And my role as Dean of the Texas McCombs Business School, I have my wings over 6,500 students getting degrees at Texas McCombs, another 6,000 getting a minor. 12,500 is a quarter of the student population at UT Austin, hungry for capitalism and innovation and prosperity. And yes, and everything is great in higher ed these days. And in the back of the room, we have several tables of executive MBA students from Texas McCombs and some brand new students who are joining our Dallas Working Professional MBA. So if you are here wishing you too could either become a Longhorn or be a second-time Longhorn, please talk to one of them or Assistant Dean Joe Stevens in the back. There are question cards at your table. We got a few in advance from you. I'm going to moderate a panel, and then we will have time for some submitted questions. And I'll take a short reminder about 2/3 of the way through where we'll go around and pick some up so that I can navigate those as well. So, to our topic at hand, which is real estate and the economy, this has become a volatile year, and the last few weeks are especially newsworthy, related to interest rates, real estate values, and we have the financial crisis of 2008 way in our rearview mirror, and yet there are a few pieces of turbulence recently that we're having to say, what did we learn then and where are we now? So over the last year, real estate industry has high inflation in the economy, worries about a recession, how much higher the interest rates will go. And we have 3 speakers with us to talk about the real estate market, the economy as a whole, what's changed, where we are today, and when we think we can offer some thoughts about the future longer-term prospects. I'm going to say their names. They will introduce themselves more. Heather McClure, here in the center, Senior Vice President, Capital Markets at Walker & Dunlop here in Dallas, is joined by Laila Assanie, our senior business economist at the Federal Reserve Bank of Dallas, and Sheridan Hitman, my mentor and a professor of finance and real estate at the McCombs School of Business, was Heather McClure's favorite professor as well. And I heard her whisper, "Don't ask me hard questions, Professor Hitman." But Sheridan tells me she most enjoyed the hard questions in class. So we have a little love fest up here. I'm going to let them talk more about themselves, their firm, the work they do day to day, how it relates to real estate. And Laila, if I can start with you, then Heather, then Sheridan. Keep this part short because we have some cool questions.
Sounds good. So thank you so much for the introduction. It's a pleasure to be here. Is this better? Yes. Awesome. I'm Laila Assanie. I'm a senior business economist with the Dallas Fed. I've been with the Dallas Fed for a while, so I've seen several moons. And lots of different things happen in the real estate sector. I specialize in looking at what the regional economy is doing. Specifically here in Texas, I study those issues, and my area of expertise within that is real estate.
Heather McClure with Walker & Dunlop. Walker & Dunlop is a mortgage banking company with all of our foundation was in the multifamily side, but now we do other commercial property as well. We're the number one Fannie Mae lender. We number 3 this year for Freddie Mac. I focus specifically, though, in the structured finance group on raising joint venture equity for developments and for acquisitions of real estate. And within that, just to caveat, a lot of my comments are on the housing side because I'm very active in the BFR sector as well as conventional multifamily and senior housing. We're also doing some self-storage and industrial within my team specifically right now.
Thanks, Heather.
Okay, I'm Sheridan Hitman. As Lil said, Lil and I have been colleagues for quite a while. I've been at UT for a bit over 25 years. I'm currently the department chair, and I teach both real estate finance and energy finance.
Thanks, Sheridan. We're going to start with where we've been recently. So not the 20 years back, but the last year or so. And to give the panelists a chance to talk about what's changed in your environment here in the last year. And Heather, I'd like to start with you with this question.
So when we were doing our panel prep, I jumped right into Silicon Valley Bank. And they said, wait, let's talk about the last year. And so just to put context, I took some notes, and 200 basis points since January 2022 to where the Treasury was at February 2023. So that's a huge increase. SOFR really is the biggest one, obviously, and I'm sure anybody who has floating rate debt, you're experiencing that. That went from like 5 basis points in January 2022 to, it was like, it's around 4.5 to 4.70 right now, bumping around. And that's a huge increase. And that has impacted, a lot of people started to do some floating rate deals, and we were actually seeing Walker & Dunlop probably about double the number of floating rate deals in 2021 and 2022. Until that happened. Cap costs have gone up so significantly that we have clients that their cap reserve that they're having to put in has increased tenfold. That makes it really hard to make your cash flow work. There's really some stress there and some opportunities from some of you looking for, if there is a little bit of stress in the market, obviously that's a huge issue. So, it's been fascinating on the debt side. This time last year, banks were lending, everything was great. Now we were with Fannie and Freddie. Fannie and Freddie are still open for business, right? They're still actively lending. But because I do a lot on the development side and on the repositioning side, floating rate debt is much harder to come by. We started seeing stress a little bit in the summer. And then come September, there were a lot of regional banks that had really pulled back. Maybe they hadn't gotten the payoffs that they'd anticipated, or because of the rise in interest rates when they were looking at their book of business, they had to bump things down in terms of their credit rating of existing deals that they'd done that were performing well, but all of a sudden the coverage wasn't as good. So we actually had a couple of clients. And this, for those of you who've been in the real estate industry, is kind of the most shocking to me right now. We've raised equity on a few deals that we're still looking for the debt 6 months after we've already identified who the equity investor is. So that's a pretty significant change where traditionally equity is harder to come by. But right now with the regional banks pulling back, especially for these development deals. We still have a couple of deals that we're still struggling to figure it out because we would initially underwritten 65%. Now we're lucky if we get 50 with a slug of recourse for regional banks. So, I mean,
Thanks.
that's a pretty significant change.
That's a big change, Heather. Laila, we are interested in your take on interest rates over the last year. Even if some of the numbers are the same, you're digesting them from a different point of view. So what's been going on in the major macroeconomic indicators that you can share with us?
Sure. So I think some things have changed over the course of 2022, entering into 2023, and some things are similar. So to just give you a...
Laila, let me stop you. Can the back row hear Laila? And if not, you're good?
Awesome.
That's why we put the young ears in the back. Okay, you're golden.
Awesome. So I think the macroeconomic climate has changed in the sense that when we started the year 2022, there was a lot of positive momentum in the economy. The economy was firing on all 4 cylinders. We had really strong job growth. Our GDP growth in 2021 was one of our best years for the U.S. economy. Housing sales were at a record high. Home prices were rising at a pace that we had not seen in many, many decades. We had supply chain issues because our demand for goods was so high that we simply couldn't keep up with it. Prices were also rising as an intended consequence, whereas when demand is high and supply is short, when you don't have the labor and you can't get the materials you need, and people are asking for that product or service, you see this huge surge in inflation. So we saw inflation pressures rise, and as a result, the Fed began to tighten monetary policy in the early part of 2022 with the intended consequence of bringing down the inflation rate within the economy. While inflation continued to rise, it peaked around 9%, the inflation rate by mid-2022. And then I guess the monetary policy started to have its intended effect, and we saw some pullback in inflation. We've seen the inflation rate come down to about 6%, which is still really high compared to from where we look at things. For the Fed, our target rate is 2%, so inflation has been steadily declining, but not to the degree that we had hoped. With monetary policy tightening, we've seen the overall pace of economic growth as well slow in the economy. We've seen a pullback in the manufacturing sector. Some of that has to do with the fact that consumption has now shifted away from people consuming goods more so, which was the case during the pandemic when we could not consume any services, to now shifting back to a more normalized pattern of consumption where goods consumption is slowing down, but we're seeing a pickup in service consumption, so there's some inflation there. The interest rate sensitive sectors, which construction and real estate is a big part of, obviously has already felt the impact of the higher rates. Rates were at 0% in February of 2022. The Fed funds rate today is 4.5%. That has fed into and played out, I think, first in the housing sector, where we've seen a huge pullback in demand for housing. We actually saw sales peak beginning of last year, and they had been trending down through most of 2022. Home prices appreciation has finally halted, so prices are declined for the second half of the year, and they're kind of holding steady. And then I think one thing that hasn't changed is our labor market. It still remains quite strong across the board. We still have a very low unemployment rate in the US. And job growth, we had expected it to slow down in the second half of the year, but it seems like the labor market really hasn't taken a pause yet.
That's good news for our MBA students. So always a dean. Sheridan, you are welcome to comment on anything you heard, of course. And I know you think a lot about cities, and it hasn't quite come up yet, but as all of us are in office environments trying to figure out who comes to work, who doesn't come to work, and then how does that have effect on real estate development, occupancy, shifting. Take anything you want, anything you want, but still keep that focus on where we've been and how it got us,
okay, so
how it affects today.
Just to start off, in terms of what's happening now and what's happening recently, the young ladies to my right know a whole lot more than I do. Although I do want to mention that I actually find it surprising that the economy hasn't been affected more by the increase in interest rates. I'm old enough to remember back to the 1980s when the interest rates, were really serious. My first mortgage was at 9%, and
Mine was 14, Sheridan.
Yeah. And so, you can see that when interest rates go up a lot, that can really crash the real estate market. And so, I guess from long-term perspectives, a 5% rate doesn't seem so high, but going from 0 to 5, you expect it to have a huge effect.
Right.
I've been thinking a lot about the long term. I've got a comparative advantage thinking about the next 10 to 15 years rather than just the next 6 months. And the long term, it's quite important for real estate because that's a very long-term asset.
Well,
And-
we're going to hold the long-term thoughts as
Okay.
we get to that.
Okay.
But do you have near-term thoughts about cities?
Well, again, it goes more into the long term than the near
Okay.
term. But the point is, and I guess this is near term. I mean, technology is very, very important, and the changing technologies having profound effects on real estate. We saw it first in retail.
Yes.
Shopping malls are not doing particularly well because of the internet. And that hit us first. And then, as you mentioned, people are working from home. It started because of COVID, but then we got technology that made it very easy to work from home. And the question is that going to stick? If people are going to continue to work from home, then the office market is going to continue to be really in bad shape. And so that's going to affect the short term, but it's also very much for the long term. So let's hold that off till when we talk
Yeah.
more about the long term.
Well, I'm going to then talk about right now and sentiment issues. And I'm going to pitch it back over to Laila as all three of our panelists talk about maybe worries about recession or how people feel about the economy in general this year compared to last year. And Laila, I think you've got some survey data from the Fed about this.
Absolutely. So I think in terms of generally, we've seen consumer confidence come down over the course of 2022. We've seen those numbers slide as uncertainty about the outlook has increased. We've seen a similar pattern in our surveys as well. So at the Dallas Fed, we conduct the Texas Business Outlook Surveys, which is a monthly survey of about 500 businesses across the state of Texas. We have a similar survey for our banking folks within the district. And then we have a couple of other surveys that we run, which is our energy survey and our agricultural survey. So if I look across the survey data, the outlooks were extremely rosy. At the beginning of 2022, businesses were doing really well because demand was exceptionally strong for both their products and their services. Consumers were really happy because they were flushed with cash, because they had quite a bit of money from the stimulus programs that were done in the prior year. Also, the job market was really strong, so you could easily switch in and out of jobs, and so you had lots of job opportunity. On the business side, confidence was high because they were doing relatively well. Again, as we've seen rates rise, we've seen the outlooks become more and more pessimistic throughout the course of 2022, entering into 2023. So the outlooks across the board, regardless of what sector you are in, with the exception of maybe modestly positive outlook in energy, we've seen those outlooks turn quite negative during the course of the year. We've seen uncertainty rise as well. And as part of the survey, when we polled our firms to ask them what their top concerns were about the outlook, back in 2022, the 3 top concerns for firms were supply chain disruptions, I can't find the workers I need, and inflation is too high. I mean, the pricing volatility is way too high to keep up with. When we polled them this March, and so this is data from about a week ago, the top 3 concerns are now weakening demand or a potential recession in 2023, which 50% of our firms are telling us that's my top concern. The second one is risk, credit tightening. So they say that because credit has tightened and it's less available, that has become like the cost of capital has become our concern. And now the third concern is inflation now, inflationary pressures in pricing. The labor market is still a concern, but it's more of a receding concern for firms. And we've seen this, credit tightening and weakening demand emerge as top concerns for businesses.
Thank you, Laila. Heather, I'm going to also ask you the current question. And you touched a little at the beginning, but how are developers, lenders, equity investors telegraphing any changes in their underwriting or allocations?
So because we work, raising single LP money, we're talking to investors all the time, and that's traditionally, private equity companies, large family offices, insurance companies, and there's still equity available, but there certainly has been a tightening. So last year, people were willing now because they had to address. Developers develop, right? And so developers had to figure out a way to deal with supply chain issues and the increases in cost. So investors were willing to say, okay, you know what, I'm going to underwrite to higher rent growth over the next 2 to 3 years. And in some instances, people were willing to underwrite maybe 10% for year one and 8% year two, because you were seeing that type of rent growth in the market. Now we're hearing that there's some investors saying, you know what, I'm like in certain markets, not Texas, but they're like, we're going to put 0 for the first 2 years because we think that things are going to go negative. So, investors are starting to tighten what they're looking in terms of rent growth. They're certainly tightening their exit cap, or they're tightening their exit caps to some extent. Not tightening, but they're going from saying maybe it's a 4.25 to now it's 5.25 on their exit when they're looking at evaluating a deal. So it's been interesting to watch. People are still wanting to put money out. There's still a belief that, we're in Texas. We're very fortunate. I have colleagues other parts of the country that, they don't have the demographic inflows. They don't have the job growth that we have. But, so we're still going to have opportunity. But for the short term, people are certainly tightened. There was one metric that I wanted to share with y'all on our investment sales portfolio for multifamily. This is just anecdotal, but this is pre-COVID, we were at an average of $135 a unit. In Q2 2022, that had gone up to $200,000 a unit. So that's a huge increase. But by Q4, it backed down to about $165,000 a unit on average. Now, granted, there's a lot of noise in those numbers in terms of the quality of assets that were being sold during that time frame. But it does give you an idea. Values have backed down a bit, but there's still reasons to transact. Looking at your capital issues or executing your business plan. And if you've already made money, maybe it's not as much as you wanted, but you go ahead and sell. So,
thanks. We're about to shift to some long-term thinking. So if your table has a question or two to submit, can you just hold it up with your hand and we'll send some staff people around to collect it? And let me just get those hands up just for a second. Are there any? Mm-hmm. Okay, good. All right. Well, then while we're waiting for that, Sheridan, it's now time to talk about the long-term perspective. And I remember when I worked at the Treasury Department for a year, it was half economists who were there for life, and it was half lawyers who were there 2 to 4 years. And we needed them both because the lawyers were in and out cutting edge about tax shelters, and the economists could say, well, back in 1984, we tried that, and here's what happened. And the Treasury Department really needed both perspectives. So we need you, Sheridan. What are you thinking with your long-term perspective about the next 5 to 10 years, 15 years?
Okay, so I'm not very good at predicting anything.
Right. These are not speculations. These are not predictions.
But I'm reasonably good at basically saying these are the factors that are going to be very, very important. And as I was starting to mention before, we need to understand the technology better.
Yes.
And one of the things, just to mention, at the University of Texas, one way we're thinking about our real estate center is that our real estate people, it's in the finance department, but we've got to go and talk to people in other parts of the university to really understand
more than we do.
Right. So we need to understand the technology. And as I was starting to mention before, we were hit by COVID, we were working from home, but then the shock that follows that is that we get just better and better technology for working from home.
Yes.
And so the real question, and this is extremely important for the office market, but important for where we live as well, is this going to continue? Are we going to work from home for 2 days a week? Are we going to all go back to the office? Okay, this is going to affect where we work, but it also is going to affect where we live. We're more willing to live farther from the office if we go in 3 days a week rather than 5 days a week. Okay, so this has already had some profound effects. Suburban housing has gotten more expensive relative to urban housing. Is that going to be amplified over time, or is that going to sort of go back to the way it was before? The other factor that we think about a lot, and we talk to people in computer science about this.
Yes.
This is about robotics and self-driving cars and transportation in general. We've got a lot of people at the University of Texas that are transportation engineers, and they think about a lot of things in transportation. And if you want to think about real estate, you need to understand transportation. We had a developer come into our class. They were talking about building a big office building downtown Austin, and they said the problem with building a big office building in downtown Austin is Austin's a car-centric city, just like Dallas, I guess. And if you have an 80-floor building, they were saying you needed 18 floors of parking. And they were saying, this is crazy, 18 floors of parking. You just can't make it work. So in terms of how you build buildings is going to depend on how people are transported to the office. And if you can, if we talk a lot about Midtown Manhattan, where you've got big office buildings, but nobody actually parks there. They all they go into Grand Central Station. So if you've got more rails, that's going to affect how the buildings are developed. That's going to affect where people live. The people in computer science are saying that if you do have self-driving cars, the capacity of the highway more than doubles. So we can bring in twice as many people to the central business district from the suburbs. And if there's self-driving Ubers, you don't actually need to park them. So that's going to have a very large effect on the real estate there as well. And the third thing, just to mention very briefly, because I don't talk to the construction engineers as much as I should, but construction is going to be very important. We've seen very little in terms of productivity increases in construction, in building, over the last 50 years. And that's one of the reasons building costs have gone up, and that's one of the reasons why urban real estate has gotten more expensive. And people are saying maybe we're ripe for innovation in the building sector now. I just was reading something about we can design houses with ChatGPT. So maybe that's not good for architects, but that may cut the cost of building. So again, in the long run, that's going to have important implications on real estate.
Well, Sheridan's department hired a really great young scholar, graduated from Wharton, who studies the disruption of Uber in these metro environments. Her data was from Philadelphia. And when everyone was on the train, all the 4- and 5-star restaurants were along the train corridors. As Uber got deployed in different counties, really great restaurants opened up in the suburbs, because these are modern times where drinking and driving it's never been good for you, but now there's more consequences to it. And so you can map that where the Ubers and Lyfts get their licensing, within a little bit of time, better restaurants pop up, because the access that it provides changes the restaurant market.
Right, and then that changes the retail market around the restaurant.
Sure.
It makes it more attractive to live in those neighborhoods. You get urban development. All these things sort of build on each other.
Yeah.
And again, a little spark can have a big effect.
Yes. Laila, we'll go to you about what the Fed's looking at when it thinks long-term about Texas economy and Texas real estate. And Christine, can you sneak over here with those so I can look at them while, thank you.
So I
Thanks,
think
thanks.
what we look at is a focus on the demographic data for this state. And Texas has, I would say we're all blessed here to be in Texas, because Texas is not only is it a pro-growth state, but it also has many advantages, which have helped Texas grow faster than the nation on average over the past several decades. One, we have a central location in the US. We're a lightly regulated state. We have the longest border with Mexico, which is a huge advantage for us. We have these huge ports at Corpus Christi and Galveston and the Port of Houston. We also have large land ports within our area. And I know I probably am biting my lip as I'm saying this, but our cost of living relatively is still low compared to if you look at the East and the West Coast. Certainly it has gone up over the past decade, but if you compare us to a New York or to a San Francisco, we're still relatively cheaper to live in. And so I think those factors have drawn a lot of people and businesses into the state. So on average, Texas adds jobs at a 2% pace every year on an annual basis. The US grows about 1%. So we already are growing at double the rate. And the reason we're able to do so is because of demographics and migration. Our population in the state was 21 million in 2000. It's just crossed 30 million at the end of 2022. And half of that growth has come from in-migration, whether it's domestic in-migration or international in-migration. And both of those have helped us not only expand, but also diversify our labor force here in Texas. So to add jobs, you also need people to be able to bring them in. And companies will not move in here if they can't find the workers that need. The advantage is that the people who are moving into Texas are younger than the average Texan, and they're more educated. And many of them come in STEM fields. They work in management and they work in finance. And all of those three occupations, we have a deficit here in the state as far as the labor force is concerned. So we've had a big advantage from that migration trend. The projections show that if we keep at this pace of migration, which I'm sure will slow because demographically we're in a decline, we're an aging nation, we will be surpassing 35 million by the beginning of the next decade. It is estimated that DFW will surpass Chicago as the third largest metropolitan area in the country by sometime in the 2030s. So there's a lot in favor for Texas, which means when people move here, they need a place to live, they need a place to work, and that feeds back into the real estate sector.
Okay, Heather, you've heard from Professor Hitman and our Fed economist. What about the future for real estate in Texas? You have a 13-year-old daughter. Would you encourage her to get into this business?
Absolutely. It's so much fun. I think I'll have her be a developer, honestly, with all of these demographics. But it's fascinating. The suburbs have seen a resurgence, and a lot of that is demographic trends. Mm-hmm. Millennials they were late to household formation, so they were staying in the inner city core a lot longer, but now they're moving out into the suburbs. That's also why Build for Rent, which is kind of in its early stages, is very popular in Texas when you can find opportunities, because it gives those millennials a place to live where they're in a home. They're not having somebody above them. They can be in good school districts. Even if they can't afford to buy a home there, they're able to rent. It gives them the flexibility that I think some of that particular demographic is really looking for, more so than maybe prior generations. So it's been fascinating to watch it. I went out to Terrell the other day. I hadn't been out there in a long time. I was amazed. There was tons of retail and really great little restaurants, and in my mind, it was just a sleepy Dairy Queen whenever I'd go down to go to Tyler. It was amazing. So it's pretty fascinating to watch the growth that's been in the suburbs and the type of retail that's there, the ease of getting to the office space, because of Texas has good roadways, comparatively speaking, and we know how to drive fast to get where we need to go.
Dallas has good roadways.
Sorry
Somebody
about
talk to my Austin politicians. Sheridan, you can have a brief last word because I have questions. You have questions. Anything to wrap up there, or should
Okay,
we?
just very briefly.
Yes.
Demographics is everything. I agree with that, and it's the type of demographics that matter. What we're seeing, at least in Austin, but I think you're seeing this in Dallas as well, is very highly educated, very highly paid people are moving to Texas. And those are the ones that are driving the real estate values, at least in Austin.
Yeah.
And so it's just not migration in general. It's basically highly educated, technical people coming in that's having a profound effect.
All right. Well, in academic circles, we joke when the person with the question says, I really have a comment rather than a question. And there's a couple here which are of that flavor because I predict Laila cannot answer this specific question, but I probably have several along the lines of why is 2% the target? And I know you are several layers below the chairman of the Federal Reserve Bank, but the questions are why isn't it 4%? Why is it 2%? And to give the comment the airing at once, why are we trying to combat inflation with interest rate increases rather than the government spending money it doesn't have? So we've... But I think what I would add to that is, as that interest rate really goes up, the debt ceiling argument will get more contentious because the federal debt actually costs the government more. But Laila, is there any of that you want to weigh in, or do you want to just throw the football to say, Sheridan, give your opinion about interest rates?
Yeah, I think the only thing I would comment is that the 2% inflation rate is sort of the long run underlying rate, a healthy rate for the economy to grow. We know prices will go up as demand goes up for stuff. Obviously, there's a whole host of economists who study this and who keep up with this, and they feel this is sort of the right underlying rate for the economy. 2% is not like, it doesn't mean it has to be 2%. It's roundabout in that buffer, so you can say it's plus minus a little bit, 50 to 100 basis points around that. The idea is that inflation eats into not just business, but also household budgets. And it hurts the lower income folks the most. And so as the Fed, because we are responsible for price stability as well as stable employment, we want to ensure that we have a fully functioning economy where everyone is able to progress. And we know that it's going to be a bigger tax on the lower income folks versus on the higher end.
Sheridan and Heather, I think this might be for you, slightly related. Can you comment on the impact of the balance sheet shrinking by $95 billion a month on the availability of real estate capital? How does it impact banks and bank loans?
Well, that's your department of coming up with debt for people.
Right, I mean,
Yeah.
on the debt side, I mean, as the balance sheet in general, but I mean, looking at banks, it was interesting because last year, all of a sudden, people were pulling back. I mean, we have a deal that credit liked, everybody liked, and then the president of the bank's like, never mind, sorry. So I think that they're getting some pushback on deploying capital, just generally speaking. But for everybody out there on the regional banking side, I mean, that is a very important component of our economy. Is, the money center banks, yeah, they're great for the big guys. They're not paying attention to the guys doing a $20 million development. And so we really need a very healthy community and regional banking system where they're actually deploying capital. We need deposits in those banks because without that, that debt capital available, then it really does, just put the brakes on, new development and, C&I loans, which is not my space at all. But I'm hopeful that we will work through these issues sooner rather than later.
Yes.
It has been painful to see it happen as quickly as it did and as impactful as it has.
Well, this is, you could weigh in a second. I think this is also Laila and Heather about over-leveraged bridge loans Are we going to get more defaults, or are we going to get extensions? What rescue capital is available? So any of you?
I don't know that some of these loans, I don't know that they actually were over leveraged. I mean, in our prior cycle, obviously with the GFC, you had really high leverage loans. Now you're not really seeing the high leverage. I mean, people were still very disciplined on the lending side, and maybe it was 65 or 70%. But now what's happened is, because of the rates going up as precipitously as they have, because of treasury rates going up and the cap rates going up, it's really, I mean, all of a sudden, it's just hard to refinance. And so, I mean, the rescue capital is going to have to come in the terms of like pref. I mean, people coming, and there's a lot of people moving into that space, trying to provide kind of an additional capital infusion with a kind of debt-like structures, but still as an equity investment.
Okay, so I'm curious, Heather. I told you I'd cold call on you one last time there, but as we're all seeing, the availability of debt capital is shrinking, but you were mentioning equity is still out there. Are we seeing any greater use of equity, less leverage in deals, or are they still wanting to basically have a pretty high leverage ratio?
For developments, so I'm very active in the BFR space, and that's a really fascinating area where the timeline for development is a little different than traditional multifamily, because you might buy finished lots and then you're building the homes, so you don't have quite as long on the construction timeline.
So BFR, that's build for rent.
Build for rent, yeah. Thank you, Sheridan. But so on
Thank
those,
you, Sheridan.
in some instances, the equity is willing to take that kind of higher debt, the higher price debt, because it's not outstanding as long. And specifically for housing, then you also have the agencies as an exit that is, much better priced than a bank loan right now, with where SOFR is, or prime for that matter.
But you're not seeing someone saying, usually I'll put in 30% equity into this deal.
They might say, we'll
equity's
do
tough,
40, 45. I mean, so some of the equity's willing to take, a little bit lower, loan to value. I mean, they're just looking at kind of the overall exit. And if you think about it, I mean, from the pullback on the banks, there's not going to be as much developed, but you still have all the people moving in, so there's still demand.
Right.
Yeah. Laila, did you want to weigh in on this
No,
one?
I
or
think
wait for
they've
the next
covered
one?
everything.
Okay. Well, this one really is more in the Fed's wheelhouse, and it's not direct to real estate, but since I'm interested, I'm asking. There are several countries now agreeing to trade in their own currency. What thoughts do you have about the health of the US dollar? We had a little recent turbulence in cryptocurrency, of course, so I think a lot about the strength of what currencies we're dealing in. It's a little off topic, but do you have anything to say about the US dollar?
I'm actually very limited in terms of how much I can comment on the dollar and its strength. But I think the only comment I would make is that most of the transactions around the world and commodity pricing today happens in the dollar. So you can say in certain ways the dollar is sort of the reigning currency of the world. All of our trading happens in that sense, and we have a central bank which obviously has the tools, and a treasury which is there to stand and back the dollar as needed. So I'm going to pause there and then have you turn to the next question.
Sure, no problem. This one's also a little off the real estate topic. We did energy in Houston about a week ago. But Sheridan, you introduced yourself as both real estate and energy, so I'm going to open the question. I might try to phrase it a little more moderately. It's a question around capital available for oil and gas, and there are a lot of pressures in states other than ours to say, if you're investing in oil and gas, you are bad somehow, and we should create pressures to restrict that investment. And this writer is a little worried, as am I. Does that ultimately lead to much higher prices of oil and gas if you've restricted the capital investment?
Well,
And I hope the writer will forgive me moderating the tone a little.
yeah, I mean, obviously, if we can't invest in developing the oil reserves, ultimately oil prices are going to be higher. I think it's been exaggerated, though, in terms of how much restrictions there's been, in terms of its effect on worldwide oil prices. It certainly does have an effect. It certainly has allowed some people with private capital to have great opportunities because there's a part of that market where the public capital is walking away, and the large private equity firms are also walking away, and that's giving great opportunities for those individuals that are positioned to take advantage of that. So there is dislocation that's being caused by these views, but I don't think it's having a huge effect on worldwide oil prices as of now.
Okay, well, when you're moderator, you get all the fun, because here is a question about, it's for Laila primarily, about the Fed's optimism economic outlook surveys. And there are two parts here. One is, what work, if ever, do you do to validate how optimistic you were with what came to pass? So they're very interested in where's the true up. So what do you do with that? Is there a historical, reliable correlation? But here's the one that grabbed me about in recent times, and Sheridan, you might weigh in. Has the Fed seen more pessimistic survey results because social media is the okay, now I'm feeling sad, is the primary method Americans use to get their news? So.
Okay, so I'll start off with the first part. So our surveys, many of them have been ongoing for more than a decade. So our Texas Business Outlook survey started back in 2004. So we have a long dated history in terms of being able to look back and look through previous periods of, recessionary periods as well as booming periods of the Texas economy. Our energy survey is a little bit newer because it started after 2010. And then we have another survey, the Ag survey, which we've had since going back into the 80s. So we have a long enough time series to be able to look back and sort of, you can say, test out how to look at some of these indexes. So when relying on the Outlook surveys, we don't just look at the sentiment indexes, because we know sentiment does sway with social media. It can sway with what you're hearing in the news on a daily basis. We track a lot of other indicators as well. So as part of our Texas Business Outlook survey, we track manufacturing production, new orders, the rate of growth of your orders, your pricing of materials, how much are you paying your employees? Are you hiring or are you laying off? What do your capital expenditure plans look like for the coming year? And we do something similar for the service sector, where we ask about revenue. In retail, we ask about retail sales, and then we again ask about pricing, hiring. And so we can look at all of these indexes in a much broader context beyond sentiment and be able to judge whether the outlook sentiments are matching. So for example, our Texas Manufacturing Outlook Survey, which manufacturing is sort of a bellwether sector for the economy. It's very cyclical. It's usually the first sector to turn over when you see a slowdown in the economy, because people pull back on goods consumption. We saw our surveys collapse back in end of 2007, right before the financial crisis. And so we knew something was kind of coming through. We saw a similar decline in our Texas Manufacturing Outlook survey back in 2015 and 2016 when the state went through an oil bust. So the US wasn't impacted as much, and we still grew, but not at the same pace. We did see our production index turn down at that point, and our growth rate of orders and new orders, which is basically new demand. We've seen a similar decline in our new orders index, and it's been pretty much negative for the last 8 months for the year. So not for this year, for 6 months of last year and 2 months of this year. And all of that is an indication to us that the sentiment negativity is not just because of the news and the media, but we actually are seeing underlying weakness in the economy as well.
Gosh, thanks, Laila.
That
Sheridan,
was really good. Thank you.
well, sorry. I should have put more irony into my tone. Sheridan, this is also a question about which data trends are correlated with others. And the question is, historically, the CRE prices are highly correlated to gross domestic product. Do you think that relationship will stay as strong?
Well, the value of real estate is always going to be highly correlated with, the economy. So that's not going to change. But the point is that economic activity isn't the only thing that affects real estate, and there's other factors that are going to become increasingly important. So it's basically, if a lot of people move to Austin, that's going to make Austin real estate prices go up. The Austin economy goes up, the real estate prices are going up. That's always going to be the case. But if we change the way we live and decide that we don't all want to live in central Austin, and instead people are willing to live farther away from the central part of the city, that's going to actually have a more profound effect on real estate prices than the aggregate economy.
Right.
And so it'll offset that. So it'll look like we're getting a disconnect between aggregate economic activity and real estate. It's not that we have a disconnect, it's just that there's other things happening as well that are going to be very important.
The technology disruptions.
Technology
Right.
disruption, where we want to live, whether the millennials really like downtown life, or whether, as I think Heather mentioned, they're having families, so they want to be suburbanites. Those things are going to have, in some sense, it could be a bigger effect on real estate than aggregate economic activity.
And Heather, the weighting towards rental properties, there are parts of the country it appears cheaper to rent than to buy a home. Do you think we still need a much bigger supply of rental properties? Do you think we're going to oversteer that one? What do you have to say about?
I think we definitely need more housing, period, right?
Yes.
We need more single-family homes, and we need more rental properties. But it's where those rental properties are and what what the unit mix is. When probably 10, 15 years ago, if I saw a 3-bedroom unit on a deal, I was like, that's ridiculous. They didn't ever lease. Well, now those 3-bedroom units, especially if it's in a more suburban environment, they're very popular and they are leasing. So, we need more housing, period, for the people that are moving into the state.
Let me just plug your research, Lil.
Thank you.
And we talked about this many years ago, but was it 2018? The tax changes in 2018 had a big effect that's not being talked about too much. It used to be that the tax code was favoring home ownership. And we talked a lot about that. But when we changed the tax code so that we no longer are subsidizing owner-occupied housing, that isn't getting the same discussion. And it could have some relationship to your business with the build for rent.
Absolutely.
It's
Right.
no longer a big tax advantage for these guys to own their own home. They might as well rent.
Well, and there's so many different factors that go into people deciding to rent versus own, but
Sure.
it is cheaper to rent. Even in all of our markets, it's cheaper to
Right.
rent. But you think about people don't have the down payments that maybe they did because they have higher student debt. There's a lot of things that impact the reason that people would decide to rent. Sorry to talk about student debt.
And I think choices are also, I also wanted to add that choices are quite limited, right? If you look at the single family housing market, our months to inventory has been exceptionally low for almost a decade at this point, right? They said 6 months is traditionally what you would need for a balanced market. We've been under 6% for 10 years now. And so we've never had enough inventory. Whatever comes to the market sells really quickly. And so maybe that's also one reason that people get diverted to the multifamily market.
Well, and I think we still have the hangover of the GFC. I know we don't bring it up as much anymore, but still, builders turn off the spigot a lot faster than
Yes.
they did previously.
Yeah.
So we're seeing, and I'm focusing a lot more on the builders than I had historically. And we're seeing them like, okay, we're gonna do build for rent. We're gonna sell, this portion of this community to the build for rent market. Well, now, in January, things ticked up and the home sales looked like they were gonna be better. So now they're turning that spigot off again and they're gonna start trying to do more retail sales. So they're a lot more reactive to what happens in the economy because they don't wanna have that 6 months.
Absolutely, and we've seen the permits come down very quickly in the last 6 months. Single-family permits have been trending. I mean, multifamily hasn't moved much, but single-family, as soon as rates went up and mortgage rates hit 6%, builders pulled back right away. So yeah.
So this is a question, but it was an opportunity for a plug, and it's much broader to the Dallas community, but I'm going to go ahead and give the plug. The Boys and Girls Club of Dallas serves 6,000 youth in the city, and I know the citizens of Dallas, and I assume there's some Fort Worth people here, I know they're two different cities, are so generous. We feel it down at Texas McCombs, but when I walk around the city, I see the arts, the parks, the museums, and so much effort in high wealth people trying to say, how can I lift as I climb? But this writer is concerned when the outlook is wobbly or the sentiment is nervous. So I don't know that you can answer it, but do you have any thoughts about the impact of all of that on philanthropy in the nonprofit sector? And Heather, whoever. Yeah.
I can start off and Heather can add in.
And this is our last question,
So
sadly.
as part of our effort to, so the Fed, we want to make sure that we're doing outreach to all our communities across our district. And so we made we've been doing it for a really long time, but we made a conscious effort back in fall of last year when we started to include the philanthropic sector as part of our Beige Book. I don't know how many of y'all are familiar with the Beige Book. It's a survey of economic conditions that the Fed kind of reaches out to businesses across the district, and we compile those anecdotes and put out this survey. And so we started to do a section specifically on nonprofit institutions and what they were seeing, and what we're hearing that yes, it indeed has had an impact on giving, on how much funds they are receiving. They're also concerned that a lot of the funding that was put in place because of COVID has now pretty much dried up. And so especially like community colleges are having a hard time where they have the enrollment, but they don't have the funds to be able to bring those students on board. So we're hearing that. And then we're also hearing a lot of issues around food insecurity.
Yes.
And nonprofits simply not having the dollars to be able to fund it, because they've not only has the funding dried up from the private sector, but also from the government, which was in place the previous 2 years because of COVID.
Okay. I am so sad that we're out of time. And it's 9:30, and I can't wait to see all of you next year, where we will maintain optimism that we breed at the Texas McCombs School of Business, that we're working together. And here in the state of Texas, that means when we work together, the innovation increases, and that leads to prosperity no matter what economic forces we're facing. And so we'll be here together to see how we did this time next year. So thank you, Sheridan. Thank you, Heather. Thank you, Laila, and especially the Federal Reserve.